Hey investors, I hope you're doing fine. I'm Simo from Investment Research, and today I'll break down my analysis for SoFi stock on November 3rd. So SoFi stock is trading at $29.59 as of today, and by the way, it confirms what I've announced before the market open. We are down about 30 basis points on the day. Now look, I know a lot of you have been asking me about this stock, especially after that massive earnings beat last week. So let's break down what's really going on here from the perspective of equity research firms. First off, let me give you some context on where we are in the story. SoFi just reported their third quarter results on October 28th, and frankly, these numbers were exceptional. We're talking about a company that delivered 11 cents in adjusted earnings per share against an 8-cent estimate. That's a 37% beat. Revenue came in at $961.6 million, absolutely crushing the $887 million consensus. That's a 6% beat on the top line with 38% year-over-year growth. Now, from where I sit, what's really interesting here is the quality of the growth. This isn't just revenue growth for the sake of growth. SoFi added 905,000 new members in the quarter. Think about that for a second. That's record member additions, bringing their total member base to 12.6 million, up 35% year over year. But more importantly, they added 1.4 million new products. That tells me cross-sell is working. The flywheel is spinning. Let me break down the segment performance because this is where it gets really compelling. The financial services segment, which is their bread and butter, posted $419.6 million in net revenue, up 76% year over year. 76%. That's not a typo. Net interest income grew 32%, driven primarily by deposit growth. But the real story here is non-interest income more than doubled year over year to $216 million. On the lending side, they originated $9.9 billion in total loans, up 57% year over year. Personal loans hit $7.5 billion, up 53%. Student loans were $1.5 billion, up 58%. And here's something that caught my attention. Home equity loans accounted for a third of their total home loan volume. That's a smart play in this rate environment, and it shows they are diversifying their loan book intelligently. Now, the technology platform segment grew 12% to $114.6 million in revenue with a 28% contribution margin. This is the lower profile part of their business, but it's strategically important because it's high margin recurring revenue. It provides stability to the overall business model. From a profitability standpoint, we're seeing real operating leverage kick in. Adjusted EBITDA hit $277 million, up 49% year over year with a 29% margin. Net income was $139 million with a 14% margin, and their Rule of 40 score, which we use to measure the balance between growth and profitability in high growth companies, came in at 67%. That's exceptional. That puts them in elite company among fintech and tech companies. Let's talk about the balance sheet because this matters. Total deposits grew $3.4 billion to $32.9 billion. Their net interest margin came in at 5.84% for the quarter. Tangible book value increased to $7.2 billion. These are the metrics that tell me this isn't just a growth story anymore. This is a company building real financial services infrastructure. Now, management raised their full year 2025 guidance. They're now expecting adjusted net revenue of approximately $3.54 billion, up from their prior $3.38 billion guide. That's versus a street estimate of $3.43 billion. Adjusted earnings per share guidance went from 31 cents to 37 cents against a 31-cent consensus. They're also expecting to add at least 3.5 million new members for the full year, which would represent 34% growth from 2024 levels. Here's where I want to give you my view on valuation and where this stock goes from here. The street is all over the place on this name. We've got price targets ranging from $12 all the way up to $38. The average is sitting around $24 to $25. But here's the thing, I think the street is underestimating the durability of this business model. When I look at this company, I'm seeing a few things that make me constructive. Number one, they've proven they can scale profitably. The days of questioning whether SoFi can make money are over. We're seeing it in the numbers quarter after quarter. Number two, the member growth isn't slowing down. If anything, it's accelerating. Their unaided brand awareness hit 9.1% in Q3, and they're just scratching the surface in terms of market penetration. Number three, the diversification of revenue streams is working. Financial services and tech platform now account for 56% of total revenue, up 57% year over year. From a valuation perspective, if I use a multiple of around 8 times fiscal 2027 estimated adjusted net revenue, which is in line with how we value high quality fintech at scale, I can get comfortable with a price target in the mid to high 30s. Mizuho actually just put a $38 price target on this name using that exact methodology. Now let me talk about the risks, because I'm not here to just pump stocks. I want to give you the full picture. First, macroeconomic uncertainty is real. If we see a prolonged economic downturn, credit quality could deteriorate. SoFi's loan book is predominantly super prime, which is good, but nothing is bulletproof in a severe recession. Second, competition in digital banking and lending is intense. We've got everyone from traditional banks to other fintechs to big tech coming after this space. Third, regulatory risk. They have a bank charter, which is a huge competitive advantage, but it also means they're under regulatory scrutiny. The other thing I'm watching closely is their loan platform business. They originated $3.4 billion in personal loans on behalf of third parties in Q3. That's great for fee income, but it's also tied to capital markets conditions. If credit markets tighten, that revenue stream could be volatile. So where do I net out on this? Look, at $29.59, SoFi is trading at a premium to where a lot of the street has their price targets. But in my view, the market is starting to recognize that this is not just another unprofitable fintech story. This is a company with real scale, real profitability, and a massive addressable market. They're executing from a position of strength. If I had to put a rating on this, I'd say this is a buy on any weakness below $28 with a 12 to 18 month price target in the $34 to $38 range. I think the risk reward is attractive here for investors with a medium to long-term time horizon. If you're a short-term trader, you might see some consolidation after this big run, but for fundamental investors building a portfolio, I think this is a name you want to own. The catalyst calendar going forward includes their Q4 earnings in early February 2026, any updates on their crypto relaunch plans, and continued execution on member growth. I'm also watching for any commentary on how lower interest rates impact their deposit franchise and mortgage business. Lower rates could be a tailwind for originations, but a headwind for net interest margin. It's a balancing act. One more thing I want to mention, and this is something I think the market is sleeping on. CEO Anthony Noto mentioned on the earnings call that they're investing aggressively in crypto, blockchain, and AI. Now, I'm not going to speculate on what that means exactly, but if they can integrate crypto services in a compliant way and leverage AI for underwriting and personalization, that could be a meaningful differentiator. We'll see how that plays out. All right. That's my take on SoFi as of November 3rd, 2025. If you found this analysis helpful, hit that like button, subscribe to the channel, and drop a comment below with what you want me to cover next. I read every single comment. And as always, this is not financial advice. I'm sharing my research and perspective, but you need to do your own due diligence and consult with your financial advisor before making any investment decisions. Thanks for watching, and I'll see you in the next one. This is Simo from Simo Equity Research signing off.